Our next guest believes we are getting closer to a recession in the coming months, and that October low, not really the low. Let's bring in Canaccord Genuity's chief market strategist, Tony Dwyer. Tony, great to see you. So what kind of low are you bracing for?
So why don't we just give it the data? So you open the show with how the two-year note yields at the highest of the cycle. We look back since it's been at 500 stock index and since 1957, and the S&P 500 has never made the low of a cycle when it's down more than 19% before the two-year made its peak. So with the two-year making the peak of the cycle so far, that tells you that October low wasn't the low.
Okay, so then in the notes, you say that the higher the two-year yield goes, the more likely we are headed into a recession. So is that, you see that in the cards at this point? And so a recession does what to the markets?
I do, Mel. I think the soft landing scenario is because you couldn't disprove the data yet. In other words, you don't go from super fast to a recession in a tick. So it takes time to get there. So what we're basing our recession call on is the percentage of the yield curves that are inverted is at almost 87%. All you need is 55% of them to be inverted to get into a recession. Even the soft landings of 1966, 1995, and 2016, the composite leading economic indicators were nowhere near as weak as they are now. Anytime the LEIs have been here, you've gone into recession. And then lastly, not just the money supply, but the bank lending standards have tightened to a level that, and the loan demand for C&I loans are at a level that have been associated with recession. So to me, the data is there for a recession. We just haven't had enough time to get there yet.
Hey, Tony, so this is obviously backward looking if you're, you have the data here, but do you have any sense of like when stock market in a bear market usually bottom in and around a recession? Because again, this recession call by a lot of strategists and some investors too has been pushed out a little bit. A lot of people were saying just a couple weeks ago, we're in a new bull market and the bear's over. So I'm just curious, if you're right about the recession, maybe in the back half of 2023, how do the stock markets usually bottom before recessions or in them?
Dan, it's a great question. They've never bottomed before a recession. So the median number of weeks from the beginning of the recession to the S&P 500 low is 23.5 weeks. So that's why this whole call has been about the recession and why it's so important to use that data I mentioned earlier. So we know that when the 2 years making a peak, the S&P has never made the low until after the 2-year peaks, number one. That means the October low, isn't it? And we also know that the market has never bottomed before the recession even began. So, but what I want to do, Mel, if I can, is be super clear here. We're over a year into this bear market. I want to attack the next low. You don't get Armageddon negative now. We go back to that October low, and I want to attack it because it'll be when finally bad news will become bad news. And that's typically when you make that recession-based low.
And what takes us out then, Tony? Because I think, well, I mean, we admire your work a great deal. What takes us out from that bear? Like, what are you going to attack on the aggressive side, on the long side?
It's going to be the early cycle names of financials, the cyclical names, the economically sensitive names. Guy, it's really interesting. The soft landing scenario, to me, is one of it's not the best case scenario because we don't have to guess. We know exactly what's going to happen if you're in a soft landing. Inflation is going to remain elevated. The Fed is going to have to continue to tighten, and the market's and risk is going to get hit. We don't have to guess. That's what happened over the last 2 weeks. So I think what we really need is, unfortunately, to go into a recession to the point where the Fed will lower rates enough that it kickstarts a credit cycle. To Karen's point, not now when we're about to enter a potential negative credit cycle.
So Tony, how does the Fed pivoting, if at all, factor into this sort of recessionary overlay? I mean, a lot of strategists, or I don't want to say a lot, but some are banking on, some market participants certainly banking on some sort of a pivot, some sort of cutting, later on this year or maybe early next year. Does that play into this at all? And does that change your outlook for when the market bottoms?
It doesn't, Mel, only because when I look back, the only time that I can find after a tightening cycle where the Fed pivoted and it was the low was in 1995. The last rate hike happened, I believe, in February of '95. The market was already ripping, and it just kept going straight up for the year. I think it was a 34% year. So when you look at that, it really comes down to you've got to go have the unemployment rate pick up. And you know you're in a recession historically when the unemployment rate is a 0.5% for an average of 3 months above the low. So if we get a 3.9% unemployment rate, we know we're in a recession. If we know we're in a recession, we know we should be able to be about to make the low. And that creates the opportunity for a real sustainable bull market and a change in that money. The problem is money. It's not just the thought of money. There's the money system is shut down.
Tony, great to see you. Thanks.